It's only the middle of the week, and I already have 7 reasons to stay patient and hold my cash instead of buying this dip. PMI has softened, oil stays volatile, yields stay high, pressure is starting to hit the real economy, and even strong AI stories are no longer getting a free pass. There is some future support coming from bank deregulation way down in the future, and under the surface, private credit stress is building. Put it all together, and for me, this is a market that is clearly signaling it has further down to go. And at the very least, it is a market that has not earned my cash yet. Welcome to the Liam Highland Portfolio. I'm Liam, a chartered accountant documenting the build of a real stock portfolio in public. This is not financial advice, it is just my analysis of the market and the positions I hold. So, in my previous episodes, I've been presenting my arguments for why I continue to hold a large and growing cash position inside of my portfolio. I'm currently sitting on over $36,000 in cash, which is now about 34% of my portfolio. So in this episode, I'm going to be presenting the 7 conditions I'm currently keeping my eye on and explain what they mean for the market and show you why, for now, I'm more comfortable holding cash than buying this dip. Let's start with the first condition, which is PMI. PMI is a quick health check on the economy. It tells us whether businesses are seeing more demand, more orders, or more activity, or whether things are starting to actually slow down. We got the latest data this week, and it was not great. There's a whole bunch of factors I could go over in this report, but simply put, growth in the economy is still there, but it is softer. Now, softer growth on its own is one thing. However, softer growth while inflation pressure is still present is something else entirely. So the first condition didn't tell me to rush into the market. It told me to stay alert. And that was only the first reason I'm still waiting. The second is oil, right? Oil continues to face disruption, elevating price levels. And these fears continue to bleed into everything else. We've got inflation, consumer confidence, valuations, and rate expectations all being impacted by this debacle. That is still the main bear case for my portfolio. So when I look at the market, I'm still asking the same simple question. Is oil calming down, or is it remaining volatile? Well, the answer is pretty simple at this point, which is it's still volatile. And given this, for me, the market has not earned a meaningful risk-on move just yet. Now, this is where it gets worse because oil feeds straight into the third condition, which are yields. If growth is softening, you would normally hope that that gives the market some sort of relief. But if oil keeps the inflation pressure up, then yields do not get the clean move lower that we would like to see. And that means money stays expensive. Now, that isn't good news for stocks, especially for growth and tech, because when money stays expensive, the market is less generous about what it is willing to pay for those future corporate profits. So now we find ourselves in a tougher setup. Growth is softer, but money is still expensive. That is not the kind of backdrop where I feel any pressure to buy aggressively into the market just because the stocks are lower than they were a few days or weeks ago. But just in case you thought it can't get worse, it does. Because the fourth condition is that this pressure is starting to hit the real economy. Mortgage rates have hit their highest level since October as bond yields stay elevated, with the average 30-year fixed rate rising to 6.43% and mortgage applications falling sharply. This is telling us that this is no longer just something on stock charts. This is pressure that is starting to leak into real decisions by average consumers. It's real borrowing and real economic activity being impacted. Now, when we start seeing this pressure start leaking out of the markets and into the real economy, there is an increased risk on the overall demand for goods and services, giving me yet another reason to stay patient and be selective. And then the market gave us one more message this week, this time through the AI story, which is the fifth condition I'm following. The long-term AI story still looks good, right? The demand is still there. But what has changed is that the tech sector's valuation premium has nearly disappeared. The market is no longer pricing AI as pure upside. They're starting to price in lower future margins as these businesses carry higher ongoing infrastructure and maintenance capex just to service the growing compute demand for these AI models. Now let's just zoom out for a minute, because beyond the 5 conditions we've discussed so far, PMI, oil, yields, real economic activity, and the AI premium vanishing, there are 2 more forces at play here. The first one is a bit of a positive, but isn't going to happen anytime soon. And the second is definitely a negative. The first is future support for the economy via bank deregulation. On March 19th, the Fed and others asked for comment on 3 proposals to modernize bank capital rules. Those proposals could eventually make lending a bit easier and lower friction in the system. But this is a 90-day consultation process, with comments open until June 18th, and the agencies themselves say this capital impact is expected to be only modest to moderate. So yes, that could help later. It could help a friendlier backdrop for lending over time, but it is not an immediate catalyst, and it is certainly not one that changes the short-term setup for me. And the second is a negative for the overall economy, which is that the private credit stress is brewing under the surface. For awareness, private credit is where, say, a mid-sized company is needing a big loan for an acquisition or some sort of expansion, but instead of borrowing from a bank who are potentially too small to provide that loan, it borrows from an investment fund at a higher interest rate. That's private credit. Now this week, private credit strains are now rippling into Wall Street, with some major US banks tightening lending, while firms like BlackRock and Ares have capped withdrawals. And to me, this is yet another sign that the financial conditions are not exactly loosening under the surface. When stress starts building in credit markets, I think that is another reason to stay patient. So when you step back and look at all of these conditions together, the conclusion is pretty simple. PMI says growth is softer. Oil says inflation risk is still alive. Yields say money is still expensive. The real economy is starting to feel it. And even the AI trade is getting more scrutiny. While we've got the bank deregulation that may help in the future, it's not an immediate catalyst. And private credit stress says there's still pressure under the surface. So for me, all of that points in the same direction, which is patience. So now you may ask me, well, Liam, if you're holding cash, isn't it getting eroded by inflation? Well, my answer is no. That cash is being held in an interest-bearing savings account while I wait. So this is not exactly money just sitting there under my mattress doing nothing. It is liquid, but it is also earning something. And most importantly, it is available when I actually want to act. Well, then you may ask, well, Liam, aren't you just trying to time the market? And you can't time the market. It's about time in the market, and you should just dollar cost average monthly. And again, my answer is no. I'm not trying to time the market, but I'm also not a passive ETF buyer just blindly averaging into everything regardless of conditions. I'm buying individual stocks. So if the macro backdrop is deteriorating, which it is, rates are still high, oil is still a problem, and the market is getting more demanding, I do not think ignoring that is some sort of portfolio discipline. I think that is putting your head in the sand. Now, for me, this is not about calling the exact bottom. It is about thinking for myself, analyzing the conditions in front of me, and deploying capital when the odds improve. That is a very different thing. So, as we ride out the rest of this week, my base case right now is very simple. I still expect a messy market. I still expect volatility. I still think oil is going to remain central to the story for everyone. And I still think the market has not given me enough to justify deploying more capital just yet. This does not mean I'm bearish forever, and it does not mean I think the market cannot rally. It just means for me, the market hasn't earned my cash yet. And trust me, this isn't easy to do. With Microsoft below $370 a share right now, I want all of it. But the company is not immune to the conditions I've outlined here. So I wait. I want conditions to improve. I want pressure to ease. And until that happens, holding dry powder is still giving me something valuable: flexibility. So there you have it. That's my view on the market right now. Tell me what you're doing. Are you holding cash, or are you actually starting to deploy? Drop it in the comments. And if you want to follow the real decisions in this portfolio, subscribe. Thank you for watching, and I'll see you in the next one.